Oil prices do not move randomly, they move on risk. And right now, risk is rising. As tensions increase in the Middle East, particularly around the Strait of Hormuz, global energy markets are watching closely. Because when geopolitical pressure builds in a region responsible for a significant portion of the world's oil supply, prices rarely remain stable. But the real question is not whether oil prices can rise. The real question is how high they could go, and how fast. To understand that, we need to understand how oil markets actually work. Oil is traded globally, and its price is influenced by supply, demand, and expectations. But expectations are often the most powerful force. If traders believe supply could be disrupted, prices can spike even before a single barrel is removed from the market. This is called a risk premium, and in times of geopolitical tension, that premium increases. The Strait of Hormuz carries nearly 20% of global oil supply. That alone makes it one of the most sensitive energy choke points in the world. If shipping traffic slows, insurance costs rise, or companies perceive even temporary instability, futures markets react immediately. We have seen this pattern before. During past regional confrontations, even minor tanker incidents triggered short-term price spikes, not because supply collapsed, but because uncertainty increased. Now consider the current environment. Global energy markets are already tight. Many economies are still managing inflationary pressure. Supply chains remain sensitive, and energy remains one of the primary drivers of consumer prices worldwide. If oil were to surge sharply, the effects would extend far beyond fuel stations. Higher oil prices increase transportation costs. Transportation affects food distribution. Manufacturing costs rise. Airline tickets become more expensive. Electricity prices increase in energy-dependent regions. Inflation, already a concern in many countries, could accelerate. And central banks would be forced to respond. Interest rate decisions could shift. Financial markets would adjust. Currencies might fluctuate. In other words, oil prices are not just about energy. They influence the entire economic system. Now, could prices truly explode? That depends on the scale of disruption. A brief period of tension may add a temporary premium of several dollars per barrel, but a sustained disruption in maritime traffic, even partial, could create a much sharper spike. The global oil market is interconnected. While alternative routes and reserves exist, replacing large volumes quickly is not simple. Strategic petroleum reserves can help cushion short-term shocks, but they are not long-term solutions. And psychological reactions in markets can amplify movement. Investors often respond to headlines before confirming data. Algorithms react instantly to geopolitical developments, and energy traders price in worst-case scenarios when uncertainty increases. However, it is also important to remain balanced. Not every geopolitical crisis leads to a prolonged oil shock. Major powers understand the economic consequences of severe disruption. Energy exporting nations also depend on stable revenue streams. Closing vital routes would hurt multiple sides. This creates a form of deterrence. But deterrence does not eliminate volatility. In moments of heightened tension, markets can swing rapidly. Even rumors can move prices, and once prices begin rising, momentum can carry them further than fundamentals alone would justify. For consumers, that means potential increases in fuel costs. For businesses, higher operating expenses. For governments, renewed pressure to manage inflation and economic stability. The connection between geopolitics and daily life becomes visible at the fuel pump. And that is why energy markets react so quickly to developments in the Middle East. Because the region remains central to global supply. Because choke points like the Strait of Hormuz concentrate risk. And because oil remains embedded in nearly every sector of the global economy, so could oil prices explode. It is possible. But more likely, we would see sharp volatility before sustained extremes, unless the crisis escalates dramatically. And that brings us to another critical factor. Energy markets do not react only to geography. They react to military capability. How credible are threats? How capable are regional actors? How quickly could escalation unfold? Understanding the strength and structure of Iran's military forces becomes essential in evaluating the true level of risk. Because in geopolitics, perception of power influences economic behavior, and markets price power as much as supply. In the next episode, we take a closer look at that dimension. How strong is Iran militarily? And how would that shape any potential escalation in this region? Until then, remember, energy flows quietly through global systems every day. But when pressure builds around key choke points, the effects can reach far beyond the region itself. This is GeoNexus, the world in focus.